And some big news we're following today. New data showing that inflation rose over 7% this past year, which is the highest rate since 1982. Joining us now is Al Lord, the founder and CEO of Lexerd Capital Management. Al, thanks for being with us.
Hey, great to be with you, Ben.
I mean, 7%, that is huge. A lot of people have seen the prices of groceries, prices of used cars, the prices of gas gone up. That's inflation. Why is it?
Yeah, exactly. Well, and KPMG survey came out and said that the average family is paying $3,500 more over the cost of it over a year on cost of everything. So that's painful, right? That's $3,500 extra out the door. Very painful. And, unfortunately, inflation's here and it's painful and it's not going away anytime soon, despite what the Fed has said and what the administration has said. Inflation's here and it's costing us a lot more everywhere, from the supermarket to the gas pump, everywhere.
So one of the terms we're hearing a lot about inflation. We're also hearing a lot about interest rates. We're kind of waiting to see if the Fed raises interest rates and how many times they're going to do it this year. What correlation do those two terms have in the situation we're in right now?
Yeah, well, they're very correlated, and the Fed has caused this inflation. I mean, it's fiscal policy and monetary policy. Those two policies combined have led to this inflation. We haven't seen 7% inflation, as you said, since 1982, 40 years ago. Well, at that point, the Fed funds rate was 11.5%. Well, right now, the Fed funds rate is 0 to a quarter point. So yes, interest rates are going to have to go up. That's the only way to bring the inflation down. That's a way to fight it. But the Fed is still buying bonds. They've slowed their purchases, but they're still buying. They should end that by March, and they're expected to raise rates for the first time beginning in March. And according to the Fed dot plot, they're going to raise them 3 times this year and 3 times next year. That still leaves rates very low compared to historical averages.
So what do you expect to see in the 12 months when it comes to our economy? It's one thing to look at the market and talk about inflation and interest rates, but people are having trouble surviving right now with everything being so expensive. If they need a new car, they might try to buy a used car, and those are inflated. Basically, everything everyone needs right now is more expensive than what we're used to seeing. What can we expect in the next 12 months? Will we see some relief when it comes to all of these different products across the industries?
Well, I hope so, but I don't expect it. I don't think we're getting relief anytime soon. We certainly still have supply chain crisis. We still have rates as low as they are, and inflation is embedded now. It's taken hold, and it's increasing, and it's going to play out through the course of the year. Now, ultimately, it will come down. The rate of change will come down, but unfortunately, it's here to stay at these higher levels. And unfortunately, it takes away from the wage gains. That we've had hard-earned wage gains that have trickled into the system. So workers are getting a higher paycheck, but unfortunately, that's been eaten away by this inflation. And so on a real basis, we just saw wages are down over 2% in real terms after taking into account the effects of inflation. So that is painful. And unfortunately, we're dependent upon the Fed to get this under control, and they're way behind the curve.
Al Lord from Lexerd Capital Management. Al, we appreciate your time. Thanks.
Great to be with you. Thank you.
Well, a New Haven police officer who had been in a coma since a September 2000